Most investors lose money in junior mining stocks, not because the sector is broken, but because they don't know how to decode them. Headlines, hype, a few flashy drill holes suck people in, and 80% of those companies will never make it. I'm Andrew O'Donnell, founder of The Market Mindset. And after years in finance and watching billions flow in and out of this sector, I built the drill sheet. 10 factors, 10 minutes, one score that filters out all the noise and shows you which stories deserve your money. First, rocks matter. Without continuity, without scale, without real 3D models, you've got nothing. The drill sheet asks, is this deposit a system or is it just a one-hit wonder? Without that foundation, the stock dies. Second, bet on people, not just rocks. Has management raised money before? Have they built a mine? Have they sold a project? The drill sheet scores the team the same way Wall Street scores CEOs, by track record, not by promises. Third, catalysts move stocks, not just rocks. Geology is the foundation, but stocks reprice on events investors can trade. Drill results that prove scale, JV deals, financing, resource updates. Without catalysts on the horizon, even great geology won't move the share price. The drill sheet maps those catalysts on a timeline, so you know if you're looking at the next re-rate or just watching cash burn. Fourth, know your multiples. If you're paying $100 million market cap for a story your peers are paying $20 million for, you're the bag holder. The drill sheet benchmarks juniors against peers to know if you're buying leverage or paying for hype. Now, let me be clear. The drill sheet is not a magic number. It's not a crystal ball. It won't predict the future or tell you when to buy or when to sell. What it does is far more practical. It filters out 80% of those juniors that are just noise, and it shines a spotlight on the small minority with legitimate prospects. It's the fastest way to reveal true potential and to know the right questions to ask next. That's why we tie it to CEO interviews. We've done hundreds of CEO interviews. The score points that spotlight, and the interviews let us drill deeper. This is book one of the Drill Sheet series, Unlocking Junior Mining Opportunities. 10 factors, 10 minutes, one score that filters noise and shows you the minority of juniors with a real shot. Here's how to try it. Download book one free right now. Every Friday, we go live with subscribers and we break down the 2 companies that we scored that week. If you subscribe now for just $9, we'll run a drill sheet on your pick, the company you want to see. Send us the ticker and you'll see the framework at work. Stop guessing. Start investing like the pros. Download Unlocking Junior Mining Opportunities today and join us on Friday. Welcome back to the Market Mindset. Today's guest is Simon Popple, a gold strategist, investor, publisher in the UK, known for his vocal, strong voice with the gold program, as well as Brookville Capital, and frequent media voice, both videos, podcasts, and print, you name it. We were just talking about Forbes earlier. Very happy about gold being where it is. We're going to put his website up here as well, but you're especially vocal about falling yields, inflation pressure, central banks' behavior, and looking at the redefining the risk-free framework. We're really looking forward to having a wide range of macro, tactical, narrative risk, the whole lot of it. Simon, great to meet you. Really happy to have you on here. And what a time of this, what's happening here with gold.
Yeah, no, fantastic to be here. Thank you very much. And yeah, your timing is perfect because there's a hell of a lot going on in the gold market.
Absolutely. Okay, before we even get into the nuances, what got you interested in this market? Because we're probably roughly the same age or close. And we'd be considered the young kids in this space right now.
Yeah, no, look, funnily enough, I kind of made my money in property, and I love property, and it's been very kind to me. I've done very well out of it. But about 20 odd years ago, I kind of started looking at commodities, and if I'm honest, I was a director of one of the world's largest private property companies. I was their youngest director, and I got out of the market, well, good 5 years too early. but I love commodities, in particular gold, and I thought they'd have a fantastic future. And since then, I've written for Money Week, which are part of the Agora group. I've written, I wrote Minds and Money for Money Week. I wrote Gold Speculator for Agora, yeah, I've just been involved in the market for many years, and I'm on the advisory board of Resourcing Tomorrow and things like that. So I kind of I've sort of slept the market for 20 years, and finally gold is is starting to become a bit more mainstream.
Yes, and I mean it's exciting to see. I always joke that when I first started, there wasn't like what you'd call a gold bug in the office, and this is the 2000s. And I was at Merrill, and it was the internet bubble heyday, just before the bubble burst. And I remember thinking, God, what mining gold? What is going on? Like, why is this guy even here? Like, which is still what you'd hear from a lot of youngsters today in the market, going, "Hey, we want to just do AI, robotics, and crypto." So I remember being that young man and viewing the world that way. But also, I mean, that 2007, 2008 crept up very quickly, and that gold bug was quite happy, but not as happy as where we're at today, where the reality is really, it isn't just a conspiracy theory or sound argument just not occurring. It seems to be the reality is sinking in, and I guess that's a good framework to start that foundation of your worldview and narrative. You can kind of go from there what your overall kind of thesis is, and just kind of tell people what your thoughts are.
Yeah, look, I mean, I think that the miners, probably particularly the junior miners, lost some of their sparkle to crypto, because the miners were where people would make sort of life-changing amounts of money, and suddenly crypto started flying. And interestingly, Bitcoin is depicted as a gold coin, by the way, but it kind of sucked a lot of money out of the mining sector, because the growth was fantastic, but I think it was also viewed as a bit of a safe haven asset as well, which I think is why events last week were so interesting, because this chart here shows what happened to Bitcoin over the last week or so, or actually you've got a bunch of different cryptos there, but you can see what happened to them over the last week or so. The price really capitulated.
Yes.
Which is kind of unusual for a safe haven asset. And to me, that would indicate that it's not a safe haven asset. It's an asset, of course it's an asset, but it's not a safe haven asset. Whereas if you look at what happened to gold, gold is just shone, and it's just going through the roof. And I think that a lot of people who had money in let's say more speculative assets such as crypto are now going, well, actually, still like it, but I want to have a bit of money in gold.
Yes.
And that kind of shift, you've got central banks buying gold. There's a lot of people buying gold. It's suddenly become very mainstream. And you can't print gold. You can't just say, oh, I want more gold. It doesn't work like that. It's kind of a real asset, and not only is it a real asset, but it's a global asset. So you could take gold anywhere in the world, whether it's Africa, Asia, US, wherever you want to take it. A piece of gold is worth whatever a piece of gold is, and it's kind of currency agnostic as well, which I think is very important, where you've got currencies perhaps becoming less popular than they used to be, and people are going, well, actually, I want to kind of protect what I've already got. Sticking it into cash may not be a great idea if the currency is going downwards. So perhaps having it in gold, where they can kind of wait and see what currency that they want further down the line, could be an attractive way of managing some cash.
Yeah, I like how you framed that too, because even when I put on all my hats and someone says, well, crypto is going to be the answer and it's going to be this and that, fine. That's a risk profile of one direction. But my thoughts to people is that even if that's true, and even if we get some sort of new strategy that there's a reset and there's a crypto coming in, and whether it's the Fed coin or whatever, you still have a transition period where you have to pick a currency. Then, well, is it going to be I have to own US dollars, or what do I want to own? And that just comes back to the macro still again. Is that, well, it's the dollar's not doing so well. I'd rather sit in a commodity, specifically gold. Never mind the fact that we touched on this before the conversation, that you've got all these central banks that are buying gold at huge rates, and they're competitive countries, one could easily argue, even leaving the BRICS part out. And if just on that angle alone, I would say, wouldn't you want to hedge your bet that even if you thought for sure it's going to be some worldwide currency and a new system, is that there's a reason why all these other countries are repatriating or buying gold at this huge rate?
Yeah, no, I mean, I think it's a very interesting narrative, and I think that a lot of people probably thought that property was the solution, or crypto was the solution. And I think people are realizing that there is not one the solution. You're not going to buy something and be okay. What you'll need is a basket of assets, and no one knows what the future is going to hold. And that basket, even though people use terms like, I don't want them to marry a gold digger, I want to win the gold medal, looking forward to my golden years, they've been as good as gold. You speak to a lot of people, they talk about gold like in their everyday language, but then when you say, do you have any? They're like, oh, well, no, I don't. And yeah. I think that gold is now becoming part of people's portfolio. And I don't think, I'm not a gold bug, so to speak, where you say, oh, we don't have 100% exposure to gold. Yeah. No, absolutely not. But I just think it's becoming part of the narrative. And that shift from going nowhere to being part of the narrative is having a massive implication on the price. And, I can't see that changing. I think, especially with central banks buying so much, that kind of indicates that, they want it to be part of their basket. So, question, why don't you have it part of yours?
Yes, and certainly property too, because it's an asset. I mean, it's a critical need. And I guess an interesting way to frame it is, how much more can you squeeze out of some of these cities, like a big city, like whether it's Vancouver, where I lived for years, that like the cost of living is so high, certainly London, any of these major cities, you go, how much more could you possibly squeeze out of a return there? And money has to look somewhere. And that's without taking into account any of the energy transition, critical metals, any of that story. Even if you discounted that and said, I don't believe it. Just the financial terms and the inflation, and money needs to flock and find somewhere to go. Where can I look now to get a return? And a lot of it happens to be looking at like high yield / junk bonds, partly because an aging generation and they need a yield. But that adds another flavor of concern on top of that. I don't know if you've looked into that at all, but what are your thoughts with that?
Yeah, well, I mean, let's touch on property first, because
sure.
We love property.
Yeah.
In 1920, it took 305 ounces of gold to buy your average home in the US. Okay, so if you wanted your average house in the US, you had to have 305 ounces of gold. Now in 2025, you need just 140. In fact, with this math is a couple of months old, so it's probably less than 140. I've got no idea what it is, but what I'm saying is it's clearly less than half. So if you kept the same gold you had in 1920, you could buy 2 of your average houses and have at least 25 ounces left of gold, which kind of shows how it holds its value. And I think property, I love property. It's done very well, but it's done very well in a low inflation environment.
Yes.
And property is a leveraged asset, and leverage is fantastic when it's going up, but it just kills you when it's going down. You could have a house that's worth $100,000. You put 10 down, it goes up 10%. You've literally doubled your money. But if it goes down 10%, you've lost all your money.
Yes.
And not only have you lost all your money, but when you come to refinance, you probably find the bank will probably say, well, actually, I don't want 10%. of your money. I want 15% of your money. And so you've then got to find another 15 grand or whatever it is, and it kind of gets ugly. And it's quite interesting sort of seeing what's happening in the market, because property, when prices are going up, it's a fantastic asset to have. First of all, we've got the leverage point I mentioned, but secondly, if I want to buy a house for $100, and you're selling it for $100, if it's, let's say, worth $105 by the time the transaction goes through, and you say, oh, look, I want 105 and got lots of interest, I'm like, well, I don't really want to say no. And the guy puts it back on the market, or the lady puts it back on the market, because by then the market value is 105, so I could end up paying 110 for it. So I kind of go, yeah, I'll pay for 105. But when the market's going down, if I offer 100 and then it comes to complete and it's only worth 95, I'm like, I think you can have 95. And they'd probably go, well, actually, I did all my maths based on 100, and I owe the mortgage company 100, so sorry, I can't do it.
Yeah.
And you're like, okay, I'm walking, and I'm not paying 100 for something that's worth 95. And suddenly, you've probably spent 3 months and I don't know how much money to actually get to that point. And one of the lovely things about property is it's so liquid. Not property, so gold is so liquid. You could literally have physical gold and say, right, I'm selling it. What time is it now in the UK? It's 4:20. I could sell it by 5:30 and have the cash in my account, if not 24 hours, certainly 48 hours. So it's incredibly liquid, and that's one of the big things I like about it, because it deals with part of my portfolio that I want some certainty over. And even though I don't have certainty about the price, I want certainty about the cash flow.
Yeah, so maybe we'll touch on a little bit about like allocation a little bit, because you've talked about like layering in physical, and some people will still be very their first bet is to go to ETF. Like they're going, oh well, I'll just buy the number on the screen. But there's risks into that as well. But how do you look at allocating, especially in this current market, your positions?
Yeah, well, I mean, that's what my gold program is really all about, because what I'm trying to teach people is how to put a portfolio together. And I don't think you should just be in physical or just be in funds. And you could perhaps have an ETF fund, or you could have a mutual fund where you're investing more in companies. But then after that, I use the fantasy football format, so goalkeepers, defenders, midfielders, forwards. I'm sure you have a similar thing in Canada, but basically a goalkeeper is a massive multinational, defenders a large company, midfielders new to production, or newish to production, or one core asset, and the forwards are your out and out explorers.
Yeah.
And I think you should have all of these in a portfolio, but I would build them as a team, because at the end of the day, you want your portfolio to to make money. And I have a lot of mates who say, hey, what should I invest in? And I'm like, well, what about getting some physical gold? And they go, oh, that's a bit boring. Okay, yeah. It's boring, but the forwards, they can literally change your life if they work out. And yes. When I say change your life, these junior miners, I don't need to tell you, but you can make 30, 40, 50, 100 times your money,
yes,
insane amounts of money.
Yeah.
But you don't want, I view them as more speculation than investment. So you
yes.
don't want a portfolio, full of them. You want to build from the back and have your physical, your funds, your goalkeepers, defenders, and midfielders. And then, you can have 2 or 3 forwards as well. And I think it's nice to live your life, making money because the team is winning the games, but also having, a couple of investments that could actually change your life. And,
yes.
We're talking about, potentially enough to put down for a house or buy a car or whatever. It's a lot of money if it works out. But if it doesn't work out, I don't want you kind of in the poorhouse. You've got to still be making money.
Yes. It's funny. I've got friends that are like, oh, you must be thrilled. I mean, with gold and silver, at the price like you're supposed to be rolling in it. I'm like, well, I am, but not the reason why you think. Like I look at the gold and silver as being okay. I've held value. Where
Yeah, no,
I'm very happy is the optionality of, well, look at these producers in the last year. Like that's where I'm like, but they're not meaning that. They're just thinking, oh, gold's gone up, you must be happy. And it's like, I am, but also I'm not because it's a reflection of what's happening in the world. It's showing the chaos and the instability. But where it is exciting, you've got that foundation is I have producers that, I mean, if you liked gold at 3,000 US gold, you could see the free cash flow. Well, imagine next quarter what it's going to look like.
Yeah, no, exactly. And it's the midfielders, which are kind of new to production. It's quite interesting because, they had a feasibility study done at, let's say, 2,000, 2,500 gold. It's now over 4,000.
Yeah.
The amount of cash they're going to generate is just insane. And yeah, costs have probably gone up, I don't know, 20%. But
yeah,
the gold price is not far off doubled for some of them.
Yes.
And the amount of cash they're going to kick off is just unbelievable.
It's actually, I know a couple of projects, I won't say who they are, but that are so attractive too. They did their feasibility studies at very, very low, and they have very low all-in sustaining costs, that even those that are looking to fund the development, they're kind of like, well, it's got like a very, very short-term window to pay back. And they're like, well, we fund that with debt. Like, is there can we force you to hold it for 5 years? They're like, no, there's a fast payout because this thing's going to be cash flow positive, like very, very quickly. And that is something that would be, a problem in the past because people, the life timeline of bringing a mine on can sometimes take quite a bit of time. But I don't see anybody, and you give me your feedback, thinking that other than pullbacks and just trading volume and whatnot, the narrative, the reality, the metrics, the economics, the political uncertainty, there's nothing indicating that, everything's perfect and solved. We get all the problems are sorted out. There's nothing I see in the near future. I don't know. Maybe you could tell me if you see something that doesn't say this looks robust.
No, I mean, I in terms of the gold price, I'm a very simple person. I forget things very, very quickly. So I used an acronym called MIDI to help remind me of what's actually driving the gold price. And I think I'd say what's happening in the US is very important to gold. But putting that to one side, the MIDI is market uncertainty, interest rates, debt, and inflation. Now, market uncertainty, you've got government shutdowns, you've got tariffs, you've got all the kind of wars and concerns in the world. Interest rates definitely trending down. People are saying how independent is the Fed because inflation's going up, interest rates going down. That doesn't kind of smell right. Debt is just getting worse and worse. Yeah. And with debt getting worse, you've got the cost of debt or cost of servicing the debt going up. And I think that's a major driver of interest rates because, people, particularly politicians, they want the cost of servicing the debt to be as low as possible. So they've got more money to spend on the things that will hopefully get them re-elected. And then you've got inflation. And inflation, we're told it's under control. There's a lot of indicators that would suggest that it still needs to be taken care of. And so those four kind of pillars, for want of a better term, of how I look at the gold price, I mean, they're all kind of like in favor of the gold price. Now, if one of them starts to change, if the inflation rate comes crashing down, or interest rates start flying up, or the debt starts coming down, or there's far less market uncertainty, then I think the gold price could really tank. But as things stand, I can't see that happening.
Yeah, right now. Let's pull up a chart here because you've got like your 1970s rhyme comparisons here. And I want to pull up a couple of these charts here where we look at 1970s. We look at some of the things that have happened in past cycles. And I see a lot of similarities to 70s, not only socially, but like with chaos, with big shifts, and there's big changes and whatnot. And it's a good place for people. Now, a lot of people don't quite remember, especially the young people we're trying to reach out to. But a lot of older people will be reminded quite quickly. And I think it's worthwhile to look at some of these charts and maybe, walk us through what you see here.
Yeah, I mean, first of all, the correlation is quite telling between what's happening now and what happened in the 70s. And this indicates that if we were to follow the 70s path, then, gold has still got a bit of a way to go. Yes, it could correct. As you can see, it corrected in the 70s. But I think that there's still a lot of gas in it. Now, what I find more interesting, to be honest, if you go on to the next graph, which is the Barron's Mining Index graph, what you'll see is there's a lag between the mining equities and the gold price. And I think that's where your listeners could have a bit of fun, because if they invest in some of these mining equities, then what they may, here you go. The red line is where we are with the Barron's Index at the moment, and the gold line is where it was in the 1970s. And now you can see this lag. And if they were to replicate what they did in the 70s, and as you've seen, the gold price has done pretty much that, then people could be in for a very nice ride. So
Yes.
yeah, I think it's obviously we don't know what's going to happen, but it looks like it could be quite exciting.
And that's kind of our job, is to see these patterns and to recognize. And it doesn't predict the future, but when there's a lot of rhyme and when you see lots of other indicators and they're all pointing, we're humans we're very habit forming. We think that we learn a lesson and we never repeat it. Like, oh, we'll learn this from history, but that's certainly, history's shown us, not the case. And it seems like we're setting up, and that asymmetric opportunity with your big name producers is there. And of course, then when you have, well, who are the mid tier, or who's got a property that's coming up in 6 months, a year, 2 years that could come on, those then also, of course, become much more attractive as well, because people start paying attention to the new exciting model of who's got free cash flow. And they're paying attention.
Exactly. I mean, I think this is one of the things I find kind of interesting about this whole thing. The people I kind of mentor through this process is they're kind of looking for complexity, and I'm like, there's no complexity. This is what you do. This is how you put a portfolio together.
Yeah.
And they're like, what about trading patterns? Where to buy, sell, do this? And like, no, there ain't any.
Yeah.
It's I think what people forget is that gold, you drill for gold. And if you think about, I don't know, a drill it's got about the circumference of that, okay, and they're drilling a mile down, and they could miss it by an inch, a centimeter, a millimeter, or they could hit it. And these holes are expensive, especially the deep holes.
Yeah.
And so you've got no idea. You've kind of got an expectation if there's a gold mine nearby, or they've already found some gold. Yes, it perhaps increases the chances, but it doesn't dramatically increase them. But I think with these explorers, one thing I'm particularly interested in is some of them have got targets where you would geologically hope that there's gold, or let's say expect there's gold, but they've never been explored. And one of the reasons they haven't been explored is because light-winged aircraft, it's just basically not safe to fly them in those areas. But with drones, you can.
Yes.
And so I think that drones could make quite a big difference to some of these explorers, because enables them to explore far more cost effectively than hiring an aircraft. And also they can look at areas that they could they could invest in, which which could actually potentially make the investors a lot of money. So, or sorry, exploring that could make the investors a lot of money. So it's I think it's quite an exciting time to be an investor in gold mining companies.
It's great because it seems, at least for part of the population, I can speak to, say, in quote unquote the West, there seems to be people kind of looking back and re-questioning a lot of things. Like, do we have this right? Where, like, with my generation, it was just, if the Fed said something, and I worked at, Merrill Lynch, well, that was gospel, and the analysis was true. And if they said, oh, don't pay attention to gold, pay attention to this, we've got that sorted, you just go, well, that's fine. Yeah. And any chaos would be resolved. It wasn't really until we saw 2008 that you go, wait a second, something's gone wrong here. And that's amplified. And now we've got a brand new generation. And once again, they're very focused on all the exciting things. I mean, look at the money flowing into AI, into robotics and whatnot. Very exciting. But, once again, how much do you think you're going to pull out of and squeeze out of the AI story right now? And if you've made a ton of money, just take the deductive reason and go, what do I need to get these drones? I need a lot of metal. If I even want to use robotics and drones for mining, I need to get this metal. And the question is that people don't seem to understand is, do we have it? No, you don't have enough of it. So that's it. It's that simple. It's not magical. You don't have to overthink it. It's just that simple.
Yeah, completely. And it's I think China has banned the export of critical minerals to the US, and you can't print them. You know what I mean? And if you need them, it kind of screws up your supply chain. You can't just say, right, we're going to have these solar panels, but they haven't got any silver in.
Yeah.
So what are you going to do? And so this is going to make companies. I'm already seeing share prices. I had a share price of a company that does antimony in Australia that went up over 25-30% last night.
Yeah.
And but yeah, I mean, some of the valuations of these companies that produce critical minerals, and that's another thing I love about the mining space, because you can be 80% into gold, but you could have 10% of your portfolio in silver, and then you have 10% of it in other stuff like copper, uranium, critical minerals, all that kind of stuff. So you could have a really broad portfolio, not just in terms of the kind of commodities you've got, but also where they are. Are they in the US? Are they in Canada? Are they in Australia? You can have an awful lot of fun with it, and it's kind of, I would really advocate having a broad portfolio, because no one knows what's going to happen. A lot of people that go, okay, well, I want to be in lithium because of car batteries and stuff like that. But if the market comes out with a way of making a car battery without lithium, if you're a lithium producer, you're kind of you're in a spot of bother. So I think a bit of diversity is vital.
Yeah, and that's a very cautious and interesting part too, because if you play it too much, like when we'd hear like the battery story, you go, well, okay, where are you getting your metals from? And then myself included, would be like, oh my goodness, I then have to understand chemistry and understand all the brand new batteries that are coming out to be certain that we have the right critical metals that we're funding for whatever future path that we're going to take, whether it's hybrid, whether it's solid state, whether it's salt batteries, you name it, whether it's vanadium flow. Like there's so much out there, and which makes it a fascinating discussion. But you can set yourself up pretty well, like you're saying, with your program, and people reach out to Simon. Let me just pull up here as well your website here, because before I pull it up, because I'll pull it up and I'll ask you a question here. Walk me through too, because I like this idea of, once again, I like to tie in AI and robotics and all those wonderful things, but all these data centers. So just the need, if the US says, let's build up Fermi in Texas, and then let's also build out, there's a Roswell Information Center, and let's also build out the Chat GTP, massive 10 gigawatt, and whether they're choosing solar plus nuclear plus what, like, that's a massive amount of metal. Maybe you can kind of comment on that maybe for us.
Yeah, absolutely. Look, I mean, all these data centers need power, and uranium is carbon free. It's changed dramatically in terms of from how it was used in the past. It's much safer, and so yeah. First of all, you've got uranium, then you've got copper, because of you need wires for these data centers, and I think there's a real need for some of these commodities. And in the past, you've been able to pretty much click your fingers and get them, and if that continues, great. But this is a tangible asset. And if you've got a country saying, we ain't going to give you our copper, or we ain't going to give you our uranium, or anything like that, then you've got a major problem. And that means you've got to, find it from one of your allies. And I think that, the world is changing. And it's interesting with gold. People just kind of assume, if you want gold, I'll just go and get some gold. Now, at the moment, yeah, you can definitely you can do that. But if you're not careful, you could technically run out of something. And
Yes.
I think that is going to be, if that happens, and it's a massive if, because there's a hell of a lot of these commodities. But sorry, that's a dog. But if we end up in a situation where there's a scarcity of any commodity, for whatever reason, I think the price could just go exponential. And which is why I advocate having a broad spread of commodities. But I like to have gold as the anchor.
Yes. I mean, and once again, I always kind of relay back to, regardless of what my opinion or XYZ on TV is, that it's got 6,000 years worth of history and data.
Yeah,
we're human
exactly.
beings.
That's
We love
bad,
it.
isn't it?
Like, we
It's
just
got data
do.
before they could write.
Yeah. And once again, if you don't like that argument, is okay, let me just show you. Like, if you just stop listening to everyone and look, what are they doing? And you can see all these federal banks, and they're buying gold. So you go, listen, you could be on TV and talk in one way, but if you're doing this over here, that's what you need to be paying attention to. It isn't the lips moving, it's what are they actually doing. And once again, if you're all into crypto, hey, it's cool. It's technology. There's some neat aspects there. But for me, why wouldn't you hedge the assumption that if the rest of the world views that maybe the US is going to do this, a crypto play, and because of the Trump administration and Bessent, why are they buying all this gold? Like, shouldn't you go, well, listen, I'm going to leave myself some optionality here?
No, exactly. And I think the other point is, to be honest, is countries, their currency is everything. It's so important. And I think that crypto will be useful, providing you can use it. But if a country has a choice between its own currency and a crypto, I think you'll choose its own currency.
Yes.
And so I think at some point, crypto definitely has got it's got uses, but I'd be careful about putting all of my eggs in that basket.
And sometimes it attracts the younger crowd, and I get it, because they saw the early massive returns. But I also remind them that original, that speculative huge return system, that was junior mining or junior exploration. That's where it comes from, and that's when people focus in on it and they start putting money into mining companies and they start to see the value. It doesn't take much. I mean, it's a small market compared to a lot of other markets. Like, never mind tech and AI. If you try to push in $1 billion into a Canadian junior markets, or 5 billion, which is penny, that's nothing. That's not a lot of money. It's going to cause a massive movement.
No, completely. A lot of these companies have got market values of like 10, 15, 20 million bucks.
Yeah.
If you start sort of chucking 5 million bucks into that, which, for some of these crypto people, that's probably what they've got down the back of the sofa.
Yeah.
You'll explode the price.
Yes.
And, some of these companies are so unloved, but they've got such massive potential.
Yeah.
I think that I get asked a lot, have I missed the boat on gold? And I kind of go, no, you kind of
Yeah.
haven't missed the boat. I don't think you've got the best seat, but you
Yeah.
haven't missed the boat.
Yeah.
But it reminds me a lot of the property market, 20 years ago, where there's a lot of people who were like, hey, it's gonna crash and there's no way the prices can keep going up. And they sat on the sidelines and all they did is just kick themselves and kick themselves. And
Yeah.
some of them sold their 4-bed house thinking, there'll be a crash and I can go and buy a 5-bed house. But they just watched the market go up and up and eventually had to dive back in, and rather than get a 4-bed house, they had to get a 3-bed house. And it's kind of like, I think the same could happen with the gold market. It's if at the moment I think it's still very attractive to get in there, and I've actually offered my clients a promotion where I said, look, if you don't get a 10.9% return on your portfolio, you get your money back, because I'm that
Fantastic.
confident that it'll do well. But and I think it will do well now. But
Yes.
if the price keeps going up and up, if we get 7,000 gold, and the miners are, let's say, 3-4 times what they are at the moment, then could it still go up? Of course it could, but I'd be less confident about the direction of travel.
Yes. And it's interesting to bring that up. People sometimes ask me, they're like, Andrew, why do you quote like Merrill Lynch or Bank of America, Merrill Lynch, or Goldman Sachs and their thoughts on gold? And I'd say it because a lot of the crowd that listens to me listens to all the other, like yourself and Rick Rule and Talking Heads, and they hear 25,000 gold, 10,000 gold, whatever that. And you know what? There are the scenarios and the math. Yeah, they're not wrong. But I like to be a bit of a sober hand to go, well, for the investment banks to even be paying attention to the extent they are, which is a lot currently. Bank of America thinks 5,000 for 2026. Goldman Sachs thinks 4,900. JP Morgan over 4,000. Deutsche Bank over 4,000. So these aren't tiny firms. Like, these aren't small investment banks with, trying to push a narrative, right? They are. I would even hesitate. They're hesitant to even want to talk about precious metals. It's not their shtick.
Yeah, no, it's. I think what is interesting about I know at least some of those banks, they've already revised their forecasts this year.
Yes.
So they kind of said, 3,500. They're like, oh, hang on, no, it'll be 4,000. No, it'll be 4.5. And so by the time we get to, where are we now, October, December, God knows what those forecasts will be. But yeah, as I said earlier, the MIDI thing, I can't see any of that kind of breaking down in the next few months. And so I do see gold going up. So in terms of entering the market, it could be a particularly good time to get in there.
Well, fantastic. We'll make sure to put the website in, and in a way to get a hold of you as well for your program, and to reach out if people have questions for you as well. But it's great to hear perspectives from the other side of the ocean as well. It's a good framework, because we get carried away on our side over here. It's wonderful to hear other people as well, so vocal, and seeing. I think you were mentioning as well, like lineups, in different places of the world to buy physical. I think there was also, was there news that to buy British coins, did they remove a tax on that as well? Or
yeah, I don't know about the tax, but I mean, you could certainly buy them without incurring capital gains tax.
That's what. Yes, that's what it was. You'd meant. Yes. Okay. Yeah.
I'm not sure if that's been removed, but it's it's that there's such a buzz around the space. There really is, and I think that people are are genuinely getting interested in it, and yeah, you can tax things, but there's only so much you can do, and I think that explorers, they do burn through a lot of money to make their discoveries. So I don't think it's an asset class that you can readily nationalized, because you'll stop all the new money coming into the market if people are worried they're going to find something that's going to get nationalized. They just won't bother. So if that happens, it's a very short term sort of action, and it's not what I'm massively concerned about, to be honest.
It's interesting when people talk about, miners burn through a lot of cash, and they do. I mean, they're basically, especially an exploration company, it's R&D. But then I kind of remind them that, well, take a look at AI, how much money they're burning through, or take a look at like anything, genetics, biotech, like pharma. They fit hundreds and hundreds of billions. Like if you got a fraction of extra inflow into the quote unquote R&D of mining, that gave it more long-term like stability of just, this is just the business, it could change the entire business entirely. And I think part of me, maybe I'm naive, is because there's this like almost awakening of people asking, do we have the bases covered here? Like, I just assumed everything was fine, but maybe I need to own gold. Well, where does gold come from? Well, maybe we need to be back in mining more. Maybe we need to make sure we control that supply chain and control that. I just assumed we had tons of it and everything else. And people are realizing, no, there's scarcity. It's a difficult business. It has to be well funded. And maybe that might wake people up too, to like, listen, if you want your robots and you want your Optimus with Tesla, and you want whatever it is you want in the future, you want AI, dominance, that's all metals. It all comes from the ground. And it's a perfect storm of events happening in the world. But also that almost all governments are recognizing the need for the critical metals, but also gold. And it is a very interesting inflection point that we are living in right now.
Yeah, no, absolutely. I mean, what you said is so true. And, I think that it hasn't been an issue in the past, because if you wanted to get your hands on this kind of stuff, you could. But it doesn't matter how good you are with your AI model or whatever, but if you can't get enough copper or whatever you need to run it, it's kind of irrelevant. And so I think commodities will, they'll do very well. Are they going to be the answer? No. Are they going to be part of the answer? I think they probably will.
Excellent. Well, we'll leave you with that. We really appreciate your thoughts on this. It's great to exchange ideas in such an incredible, robust market that we're having, and it's people like you as well that are putting in the hard work of getting the education out there, because it's up until now a bit of an unloved job for many years.
No, it's very true. It was a thankless task, but I think people are starting to wake up to it, and you don't need a huge amount of money to put your own portfolio together, and you can have a lot of fun with it. It's not all work. You can actually have a smile on your face, especially if a forward comes off. Then happy days.
Excellent. Well, once again, the website is goldprogram.co.uk. It's Simon Popple. If for some reason you can't get a hold of Simon, send me an email as well. I'll put you in connection with him. But we really appreciate you taking the time to walk us through this, Simon. It was a pleasure talking to you, and have a great evening over in the UK.
That's great. You take care of yourself.
All the best. Take care.
Bye-bye.
Most investors lose money in junior mining stocks, not because the sector is broken, but because they don't know how to decode them. Headlines, hype, a few flashy drill holes suck people in, and 80% of those companies will never make it. I'm Andrew O'Donnell, founder of The Market Mindset. And after years in finance and watching billions flow in and out of this sector, I built the drill sheet. 10 factors, 10 minutes, one score that filters out all the noise and shows you which stories deserve your money. First, rocks matter. Without continuity, without scale, without real 3D models, you've got nothing. The drill sheet asks, is this deposit a system, or is it just a one-hit wonder? Without that foundation, the stock dies. Second, bet on people, not just rocks. Has management raised money before? Have they built a mine? Have they sold a project? The drill sheet scores the team the same way Wall Street scores CEOs, by track record, not by promises. Third, catalysts move stocks, not just rocks. Geology is the foundation, but stocks reprice on events investors can trade. Drill results that prove scale, JV deals, financing, resource updates. Without catalysts on the horizon, even great geology won't move the share price. The drill sheet maps those catalysts on a timeline, so you know if you're looking at the next re-rate or just watching cash burn. Fourth, know your multiples. If you're paying $100 million market cap for a story your peers are paying $20 million for, you're the bag holder. The drill sheet benchmarks juniors against peers to know if you're buying leverage or paying for hype. Now, let me be clear. The drill sheet is not a magic number. It's not a crystal ball. It won't predict the future or tell you when to buy or when to sell. What it does is far more practical. It filters out 80% of those juniors that are just noise, and it shines a spotlight on the small minority with legitimate prospects. It's the fastest